Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, and Silicon Valley is buzzing today from the monster Figma IPO that happened yesterday. We're going to try to make sense of all of it, but really, today on the show, what we want to get to is what this IPO really means for the IPO markets and put it all into context. We got two very special guests coming on the show from Sapphire Ventures and WndrCo to help us make sense of all that. We're also going to talk about Amazon and Apple. They reported earnings last night. Coinbase also reported. We're going to get to that. And then to close out the show, we're going to go over to the land of seed investing with my friend Evan Tana from South Park Commons. He's going to come on the show. And we're going to close out with a very interesting story on microplastics. That is the subject of our weekend magazine feature this weekend. It's a busy show. We got a lot to do. So let's get right into it. We're talking about Figma. Unless you were living in the woods yesterday, Figma went public. They priced at $33. The stock opened at $85. It closed at $115. It's trading up again this morning. It's depending on what share price you take, it's about 4 times the IPO price. Market cap is many multiples higher than what Adobe offered to pay at the $20 billion price tag. Look, we have covered Figma for many years now. A couple big stories that I just want to, put in front of you for this weekend, for your weekend reading. We had a profile on Dylan Field. That is a good read. I'll link that in the show notes. We also had an analysis of its valuation. That was very interesting. And then the last story is we actually had a story about the big winners in the IPO. You've probably heard of some of the biggest winners like Kleiner Perkins and like Index. Iconic Capital is also a big winner. And my colleagues, Cory, Weinberg, and Natasha Mascarenas had a good story talking about that. But today, what we really want to do is we want to figure out what all this means, okay? And so joining me now for that discussion is Jay Das, the co-founder and president of Sapphire Ventures. He has seen 14 of his portfolio companies go public over the years. And I also want to bring on Jeffrey Nykun, a general partner at investment firm WndrCo, which also was an investor in Figma. I want to bring both of them on together, and the three of us are going to hash this all out. Gentlemen, welcome to the show. Thanks for being here.
Thanks, Akash, for having me.
Yeah, thanks, Akash. Nice to be here.
So, Jay, I want to start with you. What'd you make of it, Figma?
Well, Figma has been setting kind of, like trailblazing all along its journey, right? If you look at back in the round they did in 2019, that was like one of the first 100x ARR companies, right? They didn't actually they didn't have any revenues in the first 2 rounds they did. And then, it went along all the way. They were one of the first companies to get to 10 billion in valuation. And then, the 20 billion mark that Adobe said, or 22 billion, and now this IPO. So I think they have been a trailblazer, Silicon Valley company.
And let's just talk about the IPO yesterday. What did you make of where they priced it at, and then the pop that came after?
Yeah, that was the surprising part, right? Like, you never see a pop like this, unless it's a very retail heavy or retail focused kind of IPO. And it was surprising, right? I think the bankers really got it wrong, because if you look at, how much Dylan sold, it was like 60 million at the IPO, and it probably would have been worth 200 million now where it's trading, right? So yeah, a lot of people left a lot of money on the table. But look, it is great for the people who bought at the IPO. All the hedge funds and the long-only funds, they bought a lot, like 36 million shares, and about 54 million shares traded yesterday. So about 1.5x. So I would bet that most of the people, the hedge funds and the mutual funds who bought at the IPO probably traded out, probably 70-80% of their holdings, and then we'll probably trade back in when we get the final price in 6 months, when the lockup expires and Figma announces 2 quarters of earnings. I think that is when we'll know what price this company will trade in the future, what multiple it will trade in the future.
Jeff, let's go to you. WndrCo is a Figma investor. When you saw the price that they priced it at, $33 a share, what did you think of that?
Yeah, look, we thought it was low. The reality is, and I've been talking to Cory about this for the last 6 to 12 months. The public markets have been absent high growth software now for a long time. Prior to Figma, the highest growth software company in the market was growing less than 30%. So I think the paradigm for public investors is very different today than it was 5 or 10 years ago when they were getting good looks at all these super high quality growth software companies and growth technology companies generally. So I think this was an interesting test case in terms of seeing a super high quality software company, which Figma is, with very high growth, what level of premium the public market's willing to pay, given they haven't seen one for a long time. And look, we're in price discovery mode with the IPO, so let's see. But it's clear, it's clear that the market's going to pay up for it. And I personally think this is a signal of the changing role of how the public and private markets interact. If you look at history, the public markets were really always the source of big liquidity. If you ever wanted big liquidity as a technology company, you had to go to the public markets. You were generally a price taker. They had pricing power. Now we've transitioned to this world where if you're a great company and you never want to go public, you don't have to. You have access to the private markets. So what does that mean in my view? I think what may happen is the public market may need a different stimulus to bring companies public, which in this case is a first case, but we'll see if it's true, which is they just need to pay a premium. And I think this premium valuation may make other high quality private companies, all else equal, think, hey, I may not need to go public, but this is pretty cool if I get a meaningfully higher valuation. So I'm curious to see what comes from here, because I think it's going to be fun the next few years.
Well, I mean, look, Jeff, let's just let's do a bit of a sanity check here. I mean, like the valuation, it's depending on which share price you take, it's 50, 60 times forward revenue. I mean, what are people in your circle saying right now when they look at this valuation right now?
Yeah, I mean, look, Figma is an undeniably awesome company. I think we can all agree on that on the phone. It's got a great business model, plus high growth, plus good unit economics, plus a great management team. That said, this offering is pretty small from a liquidity perspective relative to the size of the company. So you have to bear that in mind. Two is we're sort of still in that price discovery mode,
Right.
Where, TBD, although I'm pretty optimistic earnings in a couple of weeks are going to be quite good for Figma.
Right.
And then thirdly, look, I think, like I said earlier, a unit of growth is worth more than a unit of profit. And I think in the last year plus, the public markets have really navigated towards, rule of 40 is certainly legit, but it does weight growth and margin equally. And I think if you were to look at history and just, you can play this out with a simple financial model, a unit of growth is worth more than a unit of margin. So I think
that's clearly the case here, because I think people were expecting that you had to be growing fast and you had to be quite a bit profitable. That was sort of the thinking in the last couple of years in terms of when you could IPO. Figma is, it just turned profitable. It's just getting on its way here.
Yeah,
right. But
Jay,
go ahead.
chime in here.
I think what Figma also rode was the AI kind of tailwinds, right? I think Figma had a really good AI story that went out there. And I think the market is just, craving not only for software high growth stocks, but AI stocks, right? Look at Cory, look at Palantir. So I think a lot of the retail and even the hedge funds and the mutual funds, they actually invested because of the AI story that Figma potentially has, right? And
Right.
they have built a bunch of products, not a lot of revenues there, but when you see the earnings from Microsoft and Meta, you know that there is a lot of tailwinds in AI and there is a lot of future growth. And I think that is what making people go after Figma stock.
Even though most of its business right now, it's not really, it's kind of a classic SaaS company at the end of the day.
100%. But the AI story is there, right? And I think the people believe that Figma can, they have distribution because of the number of customers they have. And, their new AI products are kind of, they're recent, but have started to take traction within the market. And I think that's what people are betting on. And the other thing is that, they showed some growth and projected growth, I think 35% for this year.
Right.
Although the last quarter, they grew only 45%. So I think the whisper numbers for their growth are probably much higher than what is in the models that they gave to the analysts.
So, I want to come to both of you on this question here. So let's look ahead now. So, Figma's happened, Circle has happened, we had CoreWeave too. So where are
Also
we now? I mean,
Palantir. Also Palantir.
right. Well, I'm talking about recent.
Okay. Yeah.
I'm talking about recent IPOs. So I mean, look, we a Circle jumped, Figma jumped, CoreWeave is also up. So Jay, let's start with you. I mean, is the IPO window now open? I mean, are companies going to start rushing in?
I don't think IPO market is open for everybody. I think IPO market still needs at least 5-6 billion of market cap, because you need at least 500 million to a billion, which is 10% of the market cap as float, to be able to be public. And you need to have a high growth story, right? So if you are going to go out there with a 20% growth at 200 million, I don't think you can IPO unless you have a really, really strong AI story that you can provide, that's saying that the growth will come because of the AI story that we have. So I don't think the IPO market is open for any kind of stock or company out there. And it'll be
Okay,
interesting to see who comes out.
Jeff, what do you think?
Yeah, I have a little bit of a different view there, which is, first of all, I think capital market conditions right now are about as good as they get, in terms of all the way around, whether you look in private markets, public markets. We are in a Goldilocks environment. I think one thing to be mindful of generally for folks is these next 6 months, don't forget about the tariffs and the flow through that those are going to have on consumer spending. I mean, I'm sure you guys saw the unemployment print today. So just something to consider. But I continue to believe that the going public decision is more at the discretion of the companies than it used to be. And the main reason a lot of them choose not to go public is they don't want to, because there's various disclosure requirements that are more onerous. There's, a level of near-term management that you're required to do with public visibility. But again, I think for the public markets to be compelling, they need to offer something. And I think this could be a sign of the future, which is they're going to offer premium valuation. And I do think to the extent this premium valuation environment persists, that will draw out some companies that are otherwise neutral about going. So I'm curious to see where Figma trades, post earnings once we've had some real data digested. But I think this could be the start of a more friendly, or just a willingness of the capital markets to recognize that, hey, they need to pay up for the quality companies.
But I mean, you talked about tariffs, and we saw it this morning. I mean, you had Figma yesterday, right? It was sort of this big acute event that happened, and then this morning the tariffs, the market's down this morning, and so there is sort of that broader uncertainty that every company has to deal with. And so, I mean, Jeff, how do you square those two things?
Yeah, well, look, I mean, I think one of the things I learned doing public markets for a long time is they tend to really capitalize current conditions. And the reality is we haven't seen the impact of tariffs in a material way yet. I mean, I think this is the first harbinger we had on this unemployment report today. But I think going forward, between the tariffs and the federal layoffs and what have you, I think there's a scenario where consumer spend, which is the vast majority of the economy, slows, and that trickles into earnings. And earnings is always the number one driver of the stock market. And right now, the earnings have been great. I mean, as Jay mentioned earlier, the big tech names have blown it out so far, and so TBD. But I think we may see some earnings impacts even on the big tech names later in the year.
Jay, what do you think?
Yeah, no, I do think the earnings are, it's up TBD, as Jeff said. But to be fair, I think there is a lot of AI tailwind in a lot of these companies, right? And I think if you look at the big tech firms who have actually been able to, really, really start using AI in their products and using it to make them more efficient, I think they are still going to have the tailwind, because I think, and I'm speaking from the Valley, right, from Silicon Valley, and being very optimistic about what AI can do.
Right.
We look at some of we didn't talk about like OpenAI and Anthropic, and the way, you guys have reported, information has done a great job reporting on their kind of revenues and the kind of growth that they have at scale. So I do think that, yes, there's macro issues that might come because of the tariffs and things. But I think the companies that are really full on into AI and have really great AI products, I think they're still going to be beating earnings.
Right. Well, look, it's a fascinating discussion. I want to thank you both for joining us. I mean, it was a big day yesterday, and we're going to be continuing to put these IPOs in context of the broader market. So, Jay and Jeff, thank you so much for joining us. It was a great conversation. That is Jay Das from Sapphire Ventures and Jeffrey Katsuyan from WndrCo. Okay, we're going to continue the conversation here and bring on our IPO reporter, Cory Weinberg. He has been following Figma and just about every other IPO, I should say, that has happened, is happening, could be happening. He is also the king of our IPO tracker that is live on our website, the information. Cory, I want to bring you in because you have been talking to people all around this ecosystem. I should say, before we get started, it's an Oakland A's jersey, am I right?
Oakland A's jersey.
What's the occasion?
It's casual Friday.
Okay.
It's IPO day. Post IPO day. I woke up in a bit of a drunken haze in a post IPO pop.
Right.
And so just wanted to keep it loose today.
Nice. Okay. All right.
Just like Wall Street clearly is with this Figma IPO.
Well, so go there. So I mean, is that what people are saying right now that you're talking to?
I mean, people are certainly saying it's irrational exuberance, like it's a textbook case study of that. I wrote this yesterday. If you were to look at the price that Figma was trading at the end of day one, it would be trading at about, sort of in the 50 times forward revenue range, which is more than double that of any other publicly traded software company, aside from the king of retail meme stocks, which is Palantir. And so no institutional investor that looked at Figma, in his roadshow said, I think this thing is worth that much. Everyone liked it. It's just kind of trading up above fundamentals in kind of a classic way.
And talk about the pricing here, because we just heard from Jay and from Jeff, and Jeff said that he thought that it was low where they had priced it at, and clearly there was some money left on the table. So why do you think they priced it where they did?
I think Figma and their CEO, Dylan Field, who I've profiled a few weeks ago, they have a track record of being fairly conservative on these sorts of things and not being that greedy. When they did a tender offer last year, 12.5 billion, which was way below the 20 billion price they had agreed to sell to Adobe a couple years earlier. Dylan Field is a CEO who took several years to even launch his product. He wanted to make sure it was perfect. He wanted to make sure it was right. And what I'm hearing now in terms of how Figma and their bankers handled this IPO, they really wanted to get stock in the hands of the longest of long-term investors, the top mutual funds, the top long onlys, as they say on Wall Street. And that by that nature, you don't have that much selling on day one, and so you're going to see the stock, the few shares that do trade hands keep trading over and over again, and that's how you see an IPO pop like this.
Talk to me about the other pre-IPO companies that you're following. We had two sort of divergent opinions just now on the show about whether or not the IPO window is now officially open. We're going to see everyone running for the floodgates, or we got this broader macroeconomic condition that is sort of overhanging the whole market. So how are other pre-IPO companies thinking about this now?
They certainly like what they're seeing. I mean, it is certainly causes CEOs and boards, particularly at high growth, sort of private companies, to look at this IPO and say, maybe we can get way more than we thought. And then that becomes a different calculation in terms of whether to raise a round privately or go public. I Parker Conrad, the CEO of Rippling, tweeted something to the effect yesterday of like, asking for a friend, what does this Figma IPO mean for late stage private SaaS? And, you can be sure that, sort of that sort of sentiment is happening around the valley. The thing, though, is to remember is like companies can't flip a switch and go public. From everything that we're tracking, there's really only, maybe a half dozen, sort of names that are, sort of VC backed, highly valued, that I'm expecting to go public, for the remainder of this year. And so for the rest of the class is 2026 at the earliest. And who knows what happens between now and then. So, we could be looking back at this and saying, man, a bunch of companies missed their window and Figma grabbed it. Or we're about to enter another, couple years of, sort of a boom cycle.
Well, look, Cory, I've really enjoyed reading all of your reporting over the past few months about Figma, and there is more to come, I know, about all these companies. So thank you for coming on the show, and I'm sure we'll have you on again when another one of these companies, starts to make some noise about rushing for the floodgates. That is Cory Weinberg, our IPO reporter. Now, look, Figma wasn't the only big news last night. We had big earnings from Apple, Amazon, and Coinbase. The three of them reported. That's just three of the companies. Other companies also reported. But I want to start with these three, and I want to give you one number from each of those prints that you need to be paying attention to. Now, for Amazon's earnings, the number that you need to focus on is 18%. That was the growth rate for Amazon Web Services in the second quarter. Its revenue growth, I should say. That growth rate was actually the same as last quarter, but the thing is, it is much slower than the growth rates that Microsoft Azure and Google Cloud have posted in the most recent quarter. I mean, both of those businesses are smaller than AWS, but Azure and other cloud services, that business line from Microsoft, it is growing at 39%. Google Cloud is growing at 31%. And then you've got AWS, which is, again, at 18%. And so that all seemed to spook Amazon investors, and that's part of the reason why the stock was trading down this morning. But those were the highlights from Amazon's earnings last night. For Apple, the number that you need to pay attention to is 10%. That is how fast the company's total revenue is growing. It was also the fastest revenue has grown since 2021. And the company said that most of that came from the popularity of the iPhone 16, which was a big factor, even though I really still don't like this side button here with the camera. My finger keeps hitting it, but that's a me problem, I think, apparently. It was iPhone sales, and then, also people jumping to buy products ahead of the tariffs was another thing that Tim Cook said had an impact. And so that was the highlights from Apple's earnings. The last earnings to get to is Coinbase. Coinbase reported last night. The number you need to know is 3%. It's kind of a small number, but that is how much revenue grew compared to last year. And if you think it's slow, the stock market did too. The shares were trading down this morning. And basically, just to walk you through what happened here, Coinbase's transaction revenue, this is where it makes money for people trading on its crypto exchange, that fell year over year, but its subscription revenue came up. Problem is, the subscription revenue coming up didn't make up for the transaction revenue falling enough to really kickstart revenue growth. And so that's why revenue growth was pretty tepid at 3%, but that is the highlight from Coinbase. Okay, we've talked about the big tech companies. Okay, we've talked about the newly big tech companies. Silicon Valley is full of those, but the bread and butter of the Valley is really its early stage ecosystem. And so I want to roll us right back into the land of seed investing. Evan Tana is a partner at South Park Commons, and the company focuses on this really interesting phase of startups, which is what they call the -1 to the 0. And so I want to bring Evan on to help us understand that. Evan, it is your first time on TITV. Welcome to the show. Thanks for being here.
Thanks, Josh. Good morning. Happy to be here.
So talk to me about -1 to 0. What does that even mean?
Yeah, well, we describe it as a kind of the phase in which you're figuring out what your next big swing is, and being patient about finding which hill you want to climb. And so we have a huge philosophy around not settling for your local maxima, but remaining really curious and pulling out some threads around where you see the world is going, but taking your time to figure out what that sort of like big impactful mountain is you want to climb. And then once you figure that out, accelerate and do it.
So figuring out basically like what is the idea that is best to work on right now in this moment.
Not even just the idea. I mean, we're pre-idea. So it's a lot around like, what vector should you be applying yourself in? Because a lot of the ideas will actually come through the -1 to 1. As we know, like the first idea that you have is unlikely to be the one that works. But what's most important is to figure out if there's like honestly founder future alignment with where you want to apply your time, effort, and intellect.
Okay, founder future alignment. So this is like what I'm working on has the potential to grow. Is that the idea?
There's that. I think it's a lot more inward too, and I'll give Mike Maples credit here. He actually coined the term founder future.
Okay.
I used to describe it as founder market fit, but I think founder future is better.
Right.
The question of like what personal experience, what insight, what hold on my camera, what sort of skills you bring to a future that you want to manifest, and making sure you figured that out. So that's what we describe the -1 to 0 as.
Got it. Got it. I want to get your take on the current state of seed investing, but I think this has to do with the -1 to 0. I mean, you guys want to run a great fellowship program. Tell us a little bit about that.
Sure. Yeah, the fellowship program is our early stage funding program, and it's a sort of three parts to it. There's community, long-term support, and capital. And the capital comes in the form of $400K upfront and $600K guaranteed in your next round. I start with community because that is the core of South Park Commons. South Park Commons, founded 10 years ago, was founded on the belief that during the -1 to 0, the best place to do it is in a talent-dense environment, a place in which you're drawing inspiration from others, you're holding yourself accountable amongst others, and really you sort of benefit from the energy of everybody else who's really technical, talented, and ambitious.
Right.
So the founder fellowship is something that we run within SPC. And so our members and our founders will come in and join the community with capital to accelerate and then go find, that mountain that they want to climb.
Right. Let's take a step back here. I kind of want to get your take on the current status of seed investing. We just talked all about IPO markets, and so now I want to come right back to seed investing. I kind of wonder, how has AI changed seed investing?
Yeah, it's a good question. I mean, I start with the obvious, which is it's an incredible time to build.
Okay.
We feel it daily within South Park Commons.
So you got to build, right?
The pace at which the large foundation model companies and the large tech companies are rolling out innovations that both enable new startups, but also keep early stage founders on their toes is I would say it's an exhilarating time. So that's number one.
Okay.
I think number two is we have seen just this proliferation of the ways in which you can apply the technology within the last 2 years. And so from our vantage point, we're seeing everything from consumer AI to robotics and deep tech to interesting vertical SaaS applications to obviously all the infrastructure and dev tools. And I would argue 2 years ago, there wasn't that level of diversity of ideas. And it's really exciting to see sort of like the technical inflection points sort of percolate into all of these different categories.
Right.
I think a third observation is we are seeing companies get to revenue a lot faster. A lot of our companies have gone from, I would argue, -1 to 1 to 10 very quickly. And so as a kind of the earliest stage investor, it's interesting because I think it sort of forces you to update priors in terms of the typical path that a venture company will take, especially in terms of how they fundraise after us. A lot of companies are going from seed to arguably what would traditionally have been Series B type investing. And it's, I mean, one, it's interesting, it's exciting, but I think it is, we're also just sort of figuring that.
Well, yeah, and you say it is exciting, and I agree with you, but it also feels a little bit scary in some ways too, because and I want to get your take on this. You go from 0 to 20, 50, $100 million in ARR so fast. And then you have to start worrying about, well, what were these experimental budgets? Is there going to be churn? How sustainable is it? I mean, how much is that on your mind right now?
Well, I think it's on the mind of all the companies that are growing this fast. I would argue this is not like a post-AI challenge. I think it's just the compressed time in which you need to figure out, which makes it a little more challenging. Right? Every growth company always has to deal with this, but I think where the time compression is an issue, or there's actually sort of a new challenge, is you're doing it with smaller teams that have sort of accelerated into this very quickly. So they're trying to figure out how to catch up. They're trying to figure out how to hire into that level of expertise. And I think that's where we see it most acutely.
Right, right. Well, look, I think I love this idea of -1 to 0, and it sounds like the fellowship is a very exciting program as well. Evan, I want to thank you for coming on and sharing with us a little bit more of a view from the ground on seed investing. And as the fund makes more investments, I look forward to having you on the show again. That is
Gosh, thanks for
Evan.
having me. This was fun.
That is Evan Tana from South Park Commons. Okay, it is Friday, and it has been a crazy week. But before we break for the weekend and let you go, I want to dive into a really fun story that we have for you. It is our weekend big read. Silicon Valley is well known for its obsessions. We have all seen the interest in longevity and supplements. And now the wellness obsessed techies have a new target. Microplastics is the new thing that everyone is talking about. And I really want to figure out what a microplastic even is. And so to do that, I want to bring on Ann Gehan, who is the reporter who authored our weekend feature about this space. Ann, this is your second time, I should say, this week that you're coming on. Welcome back.
Twice in 1 week. Thanks for having me back.
So let's get into it. I mean, we're not scientists, but what's a microplastic?
So, the technical term microplastic is a tiny splinter of plastic residue. It can be visible to the eye or not. Typically, it's 5 millimeters or less in size. But these tiny little shards come from plastic breaking down over and over and over again over time into tinier and tinier and tinier pieces. And all of these tiny little pieces of plastic find their way into soil, water, food. They've been found in basically every part of the human body. They've been found in Antarctica.
And
ocean.
most, and I want to get into the story, but just, I've got to understand it. Most of the time, can we see them, or are they pretty much invisible to us?
Typically, no.
Okay.
So we're not talking about big chunks of plastic.
Okay.
But the other thing to note is a lot of these microplastics do have other plastic chemicals that come along with them.
Okay.
So those chemicals are also where a lot of people in the tech world have kind of focused their interest and their energy is getting to the bottom of how pervasive are these chemicals and what are their impacts on people's health.
Got it. Okay. So tell us more about that. I mean, why are they so obsessed with it?
Well, I think what is so interesting about this problem and what a lot of the people that I spoke to for the story mentioned is this is like a classic tech problem because it is so large and because microplastics and these plastic chemicals are everywhere. It's a huge, gigantic problem that's a thing that tech loves to solve. So there's lots of opportunity for data collection. There's lots of opportunity for self-experimentation. And I talked to several people that are doing both of those things. So there's a lot of opportunity for people to kind of take matters into their own hands, do their own projects. Some of them are even starting companies. And so a lot of people in Silicon Valley feel like this is a really big, meaty problem that they can take all of their skills and try to crack into.
And so, what kind of businesses are these people starting around microplastics?
People are focused on the testing piece of things for now to just kind of try to quantify the problem, know what we're dealing with, know just how bad this is. So kind of the most interesting example that people mentioned to me was a project actually done last year called Plastic List. That one got a lot of attention in the tech world. It was run by Nat Friedman, who just recently moved over to Meta to run some of their AI initiatives. So just because of his kind of profile in Silicon Valley, that project got a lot of interest. And so they were going around in lots of different places in the Bay Area. They were going to Sweetgreen and Whole Foods and the Y Combinator offices and testing tap water, testing all these different products, testing different salads at Sweetgreen for.
And how do they test it? Is it like a swab or how do they do it?
Yeah, they're gathering samples and then they're sending them off to a lab testing partner and telling the lab, what chemicals they're looking for, and then kind of unpacking the data from there that they get back from the lab.
And I mean, are there large, significant investors backing this movement? Or, I mean, how much attention is this actually getting?
So Plasticless is interesting because it was a nonprofit. And actually, I spoke with another nonprofit that is trying to kind of pick up the mantle of Plasticless and use their work as a jumping off point. And so the nonprofit structure, a lot of people feel like allows them to kind of be more expansive and more ambitious in their goals. But there are a lot of people taking kind of the typical startup approach to this problem as well. So I spoke to one startup called Million Marker, which they're actually a YC vet. And that company, they make an at-home testing kit where you can send in a urine sample and they will analyze that urine sample for all of these different chemicals. They're specifically focused on chemicals that they think can disrupt your hormone levels.
Right.
The founder, actually, she started the company after she had some fertility challenges and wanted to kind of get to the bottom of what was causing those. So that's an example of one where it's at-home testing and you can get your own results, and they'll actually ask you for a list of foods that you're eating, a list of products that you're using in kind of your daily routine in your household.
And so is the answer here just to like eat organic? Is that how we remove microplastics from our diet? I'm asking for a friend here because I would like to reduce my microplastic intake as well.
For sure. And I mean, the study results are certainly scary. The headlines are definitely attention grabbing. So yeah, I mean, people want to know what the solution to this problem is. And unfortunately, right now, there's not a great answer, which is why so many people in Silicon Valley are focused on just kind of gathering data. And a lot of these startups are actually hoping to take the data that they do gather back to food companies and back to, personal care, beauty, healthcare companies and get them to try to clean up their supply chains and get the microplastics out of their product.
Got it. Well, look, it's a fascinating obsession, and I'm not surprised that people are paying attention to it. Certainly seems very on brand for Silicon Valley. And thank you so much for coming on. I really appreciate it. Next time when you hear another one of these obsessions or crazes, you're going to come right back on. You're going to tell us more about it. That is Ann Gehan. She normally covers e-commerce, but she also writes weekend features for our weekend magazine here at The Information. Well, that does it for today's show. A reminder that we are live on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I am already excited to see you all on our Monday show. So until then, have a great weekend. If you're in New York City, make sure you stay cool. Bye-bye for now.